Welcome to the debate. When you look at the history of technological scaling, there is usually this physical limit to how fast human beings can build.
Right, you're bound by the laws of physics.
Exactly. If you want to construct the world's tallest skyscraper, you literally have to pour the concrete, wait days for it to cure, weld the steel beam by beam, and build it floor by floor.
Yeah, there's a certain gravity to it, a friction that naturally paces the rate of growth.
But right now, in the artificial intelligence sector, we are watching a company attempt to build this sprawling metropolis in the clouds, basically without ever touching the ground. Today, we're looking at a fundamental shift in the financial and architectural reality of the tech industry.
And we are specifically talking about Anthropic, the company behind the Claude family of models.
Yes. They've confidentially filed an S-1 for potential October 2026 initial public offering. And, the stakes of this filing are almost beyond comprehension.
They really are, especially following that staggering $65 billion Series H funding round.
Right, which pushed Anthropic's internal valuation to $965 billion. That makes it the most valuable private AI lab in human history.
Officially surpassing OpenAI's $852 billion benchmark.
Exactly. But before we get into the details of this historic valuation, we'd like to ask you to please like, subscribe, follow, and turn on notifications for this show. It really helps us out.
Yeah, definitely hit those buttons so you don't miss any of our deep dives.
Now, as a quick update, we continue to monitor the Martin Stevens versus OpenAI matter. It is important to note that this is still not a lawsuit. We remain in a voluntary quiet period at the request of Martin Stevens to allow time for any potential developments behind the scenes. At the time of this recording, we do not know whether any progress has been made. No settlement discussions or negotiations have been publicly confirmed. We can also report that the dead man's switch has not been activated, meaning Martin Stevens remains safe from both a physical and legal standpoint. We will provide updates if circumstances change.
Right, and honestly, that entire situation perfectly sets the stage for what we're discussing today.
It really does. We're doing a deep dive into Anthropic's impending IPO, and we have to contrast that with OpenAI's notoriously delayed IPO.
Exactly. OpenAI has been bogged down by 7 active wrongful death lawsuits now?
Yeah, 7 wrongful death suits, plus the massive mental degradation lawsuits, and of course, the potential Martin Stevens lawsuit hanging over their heads.
Which makes Anthropic's move to the public markets right now so critical. We're going to analyze the raw data drawn directly from their submitted confidential paperwork, some leaked financial documents, and the extensive market reporting on their operational metrics.
We really need to figure out what this near trillion-dollar valuation actually represents. And that sets up the central disagreement we're exploring today.
Right.
Does Anthropic's unprecedented $47 billion revenue run rate, their enterprise-first focus, and their highly efficient training model represent the definitive, sustainable blueprint for the future of artificial intelligence?
Or is it all just an illusion?
Right. I am arguing that it is the definitive blueprint. I look at their capital efficiency, their jaw-dropping 80x revenue growth over the last 3 years, and their deep embeddedness in enterprise workflows. And I see absolute proof that their safety-constrained business-to-business approach is the superior winning model.
Well, and I'm taking the opposing view. I argue that this $965 billion valuation is essentially a house of cards, priced for absolute perfection, and it's masking profound structural risks.
So you see it as a bubble.
A fragile bubble, propped up by gross revenue accounting, massive and looming infrastructure debts exceeding $180 billion, and some severe vulnerabilities stemming from their commercial lockouts.
Like the Pentagon ban.
Exactly. Paired with an unresolved $1.5 billion copyright settlement.
Okay, well, let's lay out the foundation of my perspective first. I look at Anthropic and I see the paradigm of sustainable AI.
Okay, walk me through that.
For the last few years, the prevailing narrative in Silicon Valley was that to win the AI war, you had to chase this cash-incinerating consumer virality.
The OpenAI playbook.
Right. The idea was you needed hundreds of millions of free users chatting with your bot to build a moat. But Anthropic intentionally avoided that trap. They didn't build a toy for teenagers to write high school essays.
They built an enterprise juggernaut.
Exactly. And the financial realities of that decision are staggering. As of May 2026, they are sitting on a $47 billion annualized run rate.
Which is up from just $10 billion at the end of 2025.
Yeah, a massive leap. But the most crucial metric, the one that really separates a real business from a speculative research lab, is that they are projecting operating profits of $559 million in the second quarter of 2026 alone.
$559 million.
Yeah.
Pure operating profit.
And the ultimate structural advantage driving this is their capital efficiency. They are achieving this massive global scale while spending 4 times less on model training than OpenAI.
Right.
When you combine that underlying capital efficiency with incredibly deep product integration, like Claude Code, which is currently rewriting how the world develops software, it proves that this near-trillion-dollar valuation is built on durable, high annual contract value foundations.
I mean, I hear those numbers, and I completely understand why institutional investors in the broader market are just mesmerized by them.
They're hard to ignore.
They are, but my perspective is that we are looking at the illusion of infinite scaling. That $965 billion valuation is a dangerous mirage.
Why a mirage, though?
Because it is built on inflated accounting practices and staggering off-balance sheet style obligations that the public markets will punish severely once the lockup periods expire.
You're talking about the gross revenue reporting?
Yes. The primary vulnerability here is how they are actually reporting that $47 billion revenue figure. Anthropic is reporting revenue generated through cloud resellers, specifically AWS and Google Cloud, on a gross basis.
Right.
And that significantly inflates their top-line numbers without reflecting the underlying reality of their margins. But the real existential threat, the true gravity that could pull this entire city out of the clouds, is the crushing weight of their infrastructure debt.
The compute commitment.
Exactly. We're talking about over $180 billion in explicit compute commitments. That includes $100 billion to AWS, $50 billion to FluidStack, and $30 billion to Microsoft Azure.
It's a lot of compute.
It's an unprecedented amount. If there is even a slight deceleration in their growth, or if the model-to-revenue efficiency drops by even a few percentage points, those obligations become immediately fatal.
Even with the B2B focus?
Especially when you consider the severe commercial limitations their so-called safety policies impose upon them. We saw that vividly with their ejection from the Department of Defense contracts. They are pricing in a flawless future while sitting on a powder keg of fixed commitments.
Well then, let's start by dissecting the sheer scale of this revenue ramp, because I think the underlying economics of this run rate fundamentally challenge your premise of fragility.
Okay, let's look at the timeline.
Yeah, let's trace it, because it breaks literally every historical model we have for software adoption. In early 2024, Anthropic was sitting at a relatively modest $87 million run rate.
Barely a blip.
Right. By December 2024, they hit $1 billion. By the end of 2025, they were at $9 billion. Then the acceleration becomes entirely unprecedented.
$14 billion by mid-February 2026?
$30 billion by early April. And now $47 billion by May. We have to contextualize this. It took Salesforce, the absolute pioneer of the SaaS model, 20 years of grinding, building infrastructure, and educating the market to reach $30 billion in annual revenue.
Yeah, it was a generational effort.
And Anthropic did it from a standing start in under 3 years. We are not just looking at a successful product. We are looking at the fastest compounding revenue engine in corporate history.
The velocity is undeniable. I mean, nobody is arguing that the adoption curve isn't the steepest we've ever seen.
Right.
But we have to look under the hood at the mechanical nature of this revenue, because velocity without margin is just a fast track to insolvency.
You're bringing it back to the gross revenue accounting.
Yes, this is where the accounting vulnerability comes in, and it's a massive risk for any SEC reporting entity preparing for a public offering. Let's break down exactly what gross revenue accounting means in this context.
Sure.
When a Fortune 500 company, let's say a major logistics firm, wants to use Claude to optimize its supply chain, they don't usually buy it directly from Anthropic.
No, they access it through their existing cloud provider.
Exactly. Like Amazon Bedrock or Google Vertex AI, because their proprietary data is already sitting in those ecosystems.
So Amazon provisions the compute, handles the routing, and takes a massive reseller fee.
Right.
We're talking often up to 30 or 40% of the transaction value.
Right, which is completely standard channel partnership mechanics. It's how B2B software works.
Standard, yes, but how Anthropic reports it is the real issue here. Anthropic is counting that entire end customer spend as their top-line revenue. If the customer spends $10 million, Anthropic books $10 million in revenue, and then quietly logs Amazon's $3 million cut as a cost of goods sold expense.
Right.
This creates a massive optical illusion. If you look at this on a net revenue basis, which is the cash actually flowing into Anthropic's accounts and how mature software companies are evaluated by public markets, their true run rate might be closer to $28 or $30 billion.
Which is still massive.
It is still large, but it drastically changes the multiples the market is applying to them. It paints a much less rosy picture of their path to sustained profitability and their 2028 break-even target.
Okay, I see the distinction you're drawing between gross and net, but I really think focusing solely on the margin squeeze of the reseller fee misses the broader financial reality here.
How so?
Because even with those massive reseller fees booked as expenses, and even with the astronomical costs of inference for millions of daily enterprise queries, they are projecting a pure operating profit of $559 million for Q2 2026.
Yes, but
You cannot fake operating profit. The cash is either there after all expenses are paid or it isn't. And they are generating that $500 million quarterly profit while maintaining the fastest research and development velocity in the entire industry.
I mean, I hear you, but
The gross accounting might inflate the top-line optics, I'll grant you that. But the bottom-line reality is fundamentally sound.
hold on, I have to stop you there. You say the cash is either there or it isn't, but that assumes the current equilibrium holds forever.
Why wouldn't it?
The cash won't be there if the music stops, and the reason is the compute commitments. You simply cannot look at operating profit in a vacuum without looking at the structural liabilities they have taken on to generate it.
The $180 billion.
Let's outline exactly what they owe, because it is staggering. Anthropic has essentially mortgaged its entire future to the hyperscalers. They have committed contractually to spending $100 billion on AWS over the next 10 years.
Right.
They committed $50 billion to FluidStack to build out massive dedicated data centers in Texas and New York, and they committed another $30 billion to Microsoft Azure.
Okay.
That is $180 billion in explicit, locked-in infrastructure debt. And that doesn't even include the 5 gigawatts of additional TPU capacity they contracted from Google, or the separate 3.5 gigawatt custom silicon deal they struck with Google and Broadcom starting in 2027.
Which is necessary for scaling.
But do you know what 5 gigawatts looks like? It's the power consumption of a major metropolitan city. They are locked into fixed costs for a market that, while growing rapidly, is still deeply experimental for many enterprises. How can a company survive that kind of debt overhang if the enterprise appetite for AI cools even slightly?
I think you're looking at that $180 billion number as if it's traditional corporate debt. And it's not.
It's a contractual obligation.
It is, but think of these compute commitments, like an airline buying massive futures contracts on jet fuel. Yes, it looks like a staggering liability on the balance sheet today, but if you know you are going to be flying thousands of planes a day for the next decade, and you know the global supply of jet fuel is severely constrained, buying those futures is actually the most responsible thing you can do.
If the demand holds?
Exactly. And compute is the foundational resource of this century. Securing 5 gigawatts of TPU capacity isn't a liability. It is the ultimate competitive moat.
I wouldn't call it a moat when the debt is that high.
Look at the demand side of their ledger, though. 8 of the Fortune 10 are already Anthropic customers. They have over 500 enterprise customers spending more than $1 million annually, a figure that was barely a dozen just 2 years ago.
Right, but
This infrastructure spend is entirely de-risked by their incredibly sticky enterprise-grade revenue. They aren't hoping consumers will watch ads. They are deeply integrated into the core operational software of the world's largest companies.
using the word de-risked implies that these enterprise contracts are permanent, and in technology, nothing is permanent.
They're highly integrated, though.
Sure, but especially when you look at the mechanics of vendor financing that are propping this up, you have to look at the circular AI funding loop.
The investment cycle?
Yes, and it is incredibly precarious. The hyperscalers, Google, Amazon, Microsoft, are simultaneously Anthropic's investors, their infrastructure providers, and their direct competitors. Amazon gave Anthropic an $8 billion investment. In return, Anthropic committed to spending over $100 billion on AWS compute. It is a vendor financing scheme at a macroeconomic scale.
It's a strategic partnership.
Amazon gets to recognize that compute usage as AWS cloud growth, which boosts Amazon stock, while Anthropic gets the cash to pay Amazon. But what happens if Anthropic's Claude 4 or Claude 5 slips to second or third place in benchmark performance?
That's a big if.
Is it? Google has Gemini. Microsoft has OpenAI. If Anthropic's intelligence curve flattens, those Fortune 10 companies will switch their API endpoints in a heartbeat. The switching costs at the API layer are virtually zero.
Well,
And if those customers leave, Anthropic will still owe FluidStack $50 billion, and they will still owe AWS $100 billion.
but you are completely ignoring the fundamental advantage of how Anthropic uses that compute compared to its competitors.
How so?
The leaked Wall Street Journal documents revealed something absolutely critical. Anthropic is spending 4 times less on model training than OpenAI.
Right, the architecture differences.
Exactly. OpenAI is projecting that they will spend $121 billion on compute in 2028 alone, largely because they rely on brute force scaling, throwing exponentially more compute at the problem to eke out marginal gains in reasoning. OpenAI doesn't expect to break even until after 2030. Anthropic, on the other hand, relies on a highly efficient mixture of experts architecture and incredibly sophisticated synthetic data curricula. Their training costs peak around $30 billion.
Right.
They are doing vastly more with vastly less. So even if the macroeconomic climate cools, Anthropic has a much longer runway and a much lower threshold for profitability than anyone else in the frontier AI space.
Efficiency in training only matters if you can maintain dominance in distribution and product integration. Which brings us to the actual products these enterprises are buying.
Exactly. Let's examine what these enterprises are actually paying for, and whether Anthropic's tools are true, durable moats or just temporary first-mover advantages.
Okay.
We really need to look at the business-to-business product ecosystem, specifically their 2 flagship deployments, Claude Code and Claude Cowork.
Right. The autonomous agents.
Yeah. This isn't just about chatbots anymore. It is about autonomous enterprise agents. Claude Code went generally available in May 2025. By February 2026, it reached $2.5 billion in annual recurring revenue.
And that doubled quickly.
It doubled in a single month. But here is the metric that should terrify every legacy software company on Earth. Anthropic estimates that 4% of all public GitHub commits worldwide are now authored autonomously by Claude Code.
4% is massive.
It's unbelievable. We are not talking about an autocomplete tool like the early versions of Copilot, where a human types and the AI finishes the line. We're talking about agentic coding. A project manager drops a Jira ticket into the system, and Claude Code navigates the repository, writes the logic, runs the tests, and opens the pull request entirely on its own. This fundamentally shifts the economics of software development, from paying for developer seats to paying for executed tasks.
Look, I don't deny the technical achievement of Claude Code, but you have to look at the broader landscape.
Well, wait, let me finish the thought on Claude Cowork, because it proves the market's reaction to this shift.
Okay, go ahead.
Cowork is their non-technical workplace agent. In January 2026, they launched industry-specific plugins for legal, finance, and marketing.
Right.
The day they launched, it triggered a massive $285 billion sell-off in incumbent software and financial data stocks. Thomson Reuters fell 18% in a single day. FactSet dropped 10.5%.
Yeah, it was a bloodbath.
Because if Claude Cowork can autonomously ingest 10 years of SEC filings, cross-reference them with real-time news feeds, and generate a flawless M&A risk report in 14 seconds, you don't need a Bloomberg terminal, and you don't need a massive contract with Thomson Reuters.
True.
The public markets instantly recognize that Anthropic is not just selling AI, They're actively capturing the $800 billion legacy enterprise software stack.
You paint a picture of total enterprise dominance, but you are deliberately ignoring the consumer blind spot.
I don't think it's a blind spot.
It is, because in AI, the consumer is the engine of generalized intelligence. OpenAI has 900 million weekly active users on ChatGPT. That consumer scale creates an unmatched data flywheel.
Sure, lots of data.
But think about what that means. Every single conversation, every weird edge case, every complex translation, every prompt from 900 million people feeds back into their reinforcement learning from human feedback, or RLHF pipeline. It trains their models on the infinite variability of human intent. It also creates a massive organic developer ecosystem because developers build for the platform they use in their daily lives. Anthropic, by contrast, has external estimates of just 18 to 30 million consumer users.
Right, they focus on enterprise.
Which makes them a fraction of the size in mindshare. That makes them a highly specialized, highly expensive enterprise tool, and historically, specialized enterprise tools are incredibly vulnerable to commoditization.
Commoditization by whom, though?
By open-weight models. Look at Meta's Llama series, or the models coming out of Mistral.
Okay.
If a Fortune 500 company can take an open-weight model that is 95% as good as Claude, fine-tune it on their own internal data, and run it on their own private servers for a fraction of the cost, why would they continue to pay Anthropic's massive API fees?
Because running private models is a massive infrastructure headache.
But the cost savings are huge. Furthermore, OpenAI is not standing still in the enterprise space. Their Codex coding tool is growing 70% month over month. OpenAI has the distribution advantage of being deeply integrated into Microsoft Windows, Office 365, and GitHub.
Right.
Meta has 3.3 billion users across Facebook, Instagram, and WhatsApp to deploy their AI into. Anthropic simply doesn't have the consumer mindshare or the distribution ubiquity to fight a multi-front war against free open-source models on one side and OpenAI's ubiquitous distribution on the other.
I concede that 900 million users is a massive distribution channel.
It's a monopoly-level channel.
But consumer scale and revenue scale are demonstrably not the same thing in the AI era. You're applying a Web 2.0 framework where eyeballs equals value to a Web 3.0 infrastructure play.
How is it different?
Let's look at the actual numbers. OpenAI has nearly 1 billion users, yet Anthropic surpassed their revenue run rate in April. Anthropic hit a $30 billion run rate when OpenAI was struggling to cross $24 billion.
Right.
Anthropic achieved higher revenue with just 5% of the user base. Doesn't that fundamentally prove that the consumer AI raise is a distraction from the real economic prize?
I wouldn't call it a distraction.
With serving 1 billion free or low-tier consumers burns massive amounts of compute. It is a highly unprofitable endeavor. Serving Uber, Netflix, Spotify, and Salesforce with high-margin, mission-critical enterprise APIs is how you build a sustainable business.
Okay, but what about the data flywheel?
The idea that consumer data provides an infinite flywheel for reasoning is increasingly recognized as a myth. What matters for complex coding, legal analysis, and enterprise workflows is high-quality synthetic data generated by other models and highly curated proprietary data. Millions of teenagers asking a chatbot to write a poem does not help the model learn how to debug a Kubernetes cluster. Anthropic realized that human feedback plateaus, which is why they pivoted to constitutional AI and synthetic curricula.
The data might plateau, but the distribution does not. OpenAI is the default interface for AI for the general public. But let's look at your core argument for Anthropic's enterprise lock-in.
Okay.
You claim they are winning because they are a trusted, reliable infrastructure layer. They are selling trust. And to win that enterprise prize, they have instituted a rigid ethical framework. Their constitutional AI.
Right, exactly.
They have positioned themselves as the safe alternative to OpenAI's move fast and break things philosophy. But this very ethical framework, which you view as their greatest asset, has recently collided violently with real-world commercial and regulatory realities.
And that brings us perfectly to the next critical junction. Safety as an enterprise moat versus safety as a commercial liability.
Yes.
I strongly argue that Anthropic's long-term benefit trust and their strict constitutional guardrails are exactly why they are dominating highly regulated industries.
Let's look at the evidence for that.
Let's look at their expansion into healthcare and life sciences. They acquired Coefficient Bio in an all-stock deal to push into AI-native drug discovery. Why did Coefficient choose Anthropic over OpenAI?
Security compliance.
Because Claude is HIPAA ready out of the box, with native secure integrations into clinicaltrials.gov and the CMS coverage database. Furthermore, independent testing just showed that Claude Opus 4.7 achieved the highest compliance rate, 54%, with the newly implemented EU AI Act among 12 major agents.
Right.
But the absolute proof of their safety mode was how they handled the Mythos cybersecurity model in April 2026.
The Mythos situation is exactly what I'm talking about, but go ahead and explain your view of it first.
Okay, Mythos was an experimental model trained specifically for cybersecurity. During internal red teaming, Mythos autonomously discovered thousands of zero-day vulnerabilities across global software infrastructure.
Which is terrifying.
Truly terrifying. The worst one was a 17-year-old freebies bug that could grant full root access to millions of servers worldwide. An irresponsible company or an open-weight model provider might have released those capabilities publicly, claiming it was for research and caused global chaos. But Anthropic locked it down. They restricted the model to just 11 trusted launch partners and critical infrastructure organizations under what they called Project Glasswing.
Right.
Actor in the frontier AI space. When you're sitting in a Fortune 10 boardroom deciding which AI to grant read-write access to your proprietary data, that level of disciplined safety is the only thing that wins the contract.
It wins the border and right up until it costs them billions in government contracts.
I completely disagree with that framing.
Well, let's look at the stark reality of that safety stance, because I heavily critique this as a massive commercial liability, and the events of February 2026 prove it beyond a shadow of a doubt. The Department of Defense fallout was an unmitigated disaster for Anthropic's public market narrative.
I think disaster is a really strong word for a principled stance.
With a disaster for their valuation potential, let's review the mechanics of what actually happened. The Pentagon was looking to procure next-generation AI for logistical analysis and strategic wargaming.
Right.
Anthropic flatly refused the contract because their constitutional AI charter explicitly forbids the use of their models for autonomous weapons targeting and mass domestic surveillance.
Which is a valid ethical boundary.
But as a direct result of that refusal, Defense Secretary Pete Hegseth officially designated Anthropic as a supply chain risk to national security. That is not just a lost contract, that is a catastrophic regulatory label.
It was a political move.
Political or not, the president subsequently ordered all federal agencies to immediately cease using Anthropic's technology. They were ejected from the single largest procurement ecosystem on the planet. And what happened next?
OpenAI took the deal.
Exactly. Did the Pentagon suddenly discover ethics? No. OpenAI immediately stepped in and absorbed those lost DoD contracts, securing a $200 million multi-year deal. You simply cannot command a $965 billion valuation while systematically locking yourself out of the defense and intelligence sectors. The U.S. government is the ultimate enterprise customer. If you alienate them, you put a hard ceiling on your growth.
I see why you think that's a commercial weakness in the short term, but let me offer a much broader perspective on the geopolitical mechanics at play here.
Go on.
Getting banned by the Pentagon isn't just a lost $200 million contract. It is a $50 billion marketing campaign aimed directly at the European Union.
That's an interesting spin.
Think about it. By taking a short-term hit and accepting the DoD ban, aren't they essentially immunizing themselves against the massive regulatory backlash that is inevitably going to strike OpenAI? Europe is terrified of American AI being used as an extension of the U.S. military intelligence apparatus.
They are, yes.
By refusing the Pentagon, Anthropic pre-cleared themselves for total dominance in the heavily regulated, privacy-conscious EU market. This is the ultimate proof of concept for their public benefit corporation structure. Dario Amodei went on 60 Minutes and explicitly stated they are building safety first, profits second.
And the capital markets loved it.
Exactly. Institutional investors, from sovereign wealth funds like GIC and MGX to massive asset managers like BlackRock and Fidelity, poured $30 billion into their Series G because of this governance structure, not in spite of it. Institutional capital wants predictability. A company that refuses to arm autonomous weapons is a company that won't get shut down by an emergency act of Congress or banned by the European Parliament. It is long-term greed disguised as ethics.
Predictability? There's absolutely nothing predictable about a company whose stated ethics are in direct, undeniable contradiction with their operational history.
What contradiction?
You talk about their constitutional guardrails and their high-minded principles, but how deep does this ethical commitment truly run? A look at the pending litigation suggests a massive, structural hypocrisy between Anthropic's stated values and their core training methodologies.
The copyright stuff?
Yes. This brings us to the legal overhang that threatens to completely derail the IPO narrative. We have to talk about the $1.5 billion Bartz v. Anthropic copyright settlement that is awaiting final approval in May 2026.
The copyright litigation is an industry-wide issue, though. It's not an Anthropic-specific one.
It is absolutely Anthropic-specific when you look at the lengths they went to acquire the data. The Bartz class action didn't just expose that Anthropic scraped a few websites.
Right.
It exposed the fact that they relied heavily on pirated book databases like LibGen and Pulumi to train the foundational reasoning capabilities of Claude. But it goes so much deeper and darker than digital scraping.
You're talking about Project Panama.
Yes. The discovery process in the court filings detailed Project Panama. This wasn't a software engineering task. This was a covert physical operation. Anthropic actively purchased millions of physical copyrighted books. They shipped them to clandestine facilities, literally sliced the spines off the books, and ran them through massive industrial OCR scanners to feed the text into their training clusters. Internal emails revealed in discovery explicitly stated that leadership, and I quote, did not want it to be known that they were engaging in this physical digitization process.
It was definitely a bad look.
It's more than a bad look. They operated a massive, clandestine copyright infringement factory to build the very intelligence they are now selling as safe and ethical AI. It is staggering hypocrisy, and more importantly, it exposes a massive liability that could invite further devastating litigation from publishers outside the Bartz class.
Okay, let me contextualize that settlement and the realities of Project Panama. I am not going to sit here and defend the optics of physically slicing the spines off books in a warehouse.
Good, because you can't.
It looks terrible, and it clearly contradicts their public positioning. But as analysts looking at a $965 billion valuation, we have to separate moral outrage from financial pragmatism. Let's look at how the $1.5 billion settlement is actually structured.
Okay.
Anthropic is funding the settlement across 4 separate installments stretching all the way out to September 2027. The first $300 million has already been paid.
Right.
They will pay another $300 million upon final court approval later this month, $450 million in late 2026, and the final $450 million in late 2027. Think about the scale of their cash flow.
I know they have the cash, but
If a company can absorb $1.5 billion legal penalty while still posting a $559 million pure operating profit in a single quarter, it demonstrates supreme financial resilience. It doesn't show existential risk. It proves their margin profile is so incredibly robust that it can swallow the sins of their early training days without breaking a sweat.
Absorbing $1.5 billion in penalties is not a badge of honor. It is a symptom of a structurally flawed business model that inherently relies on unauthorized data extraction.
But every model relies on that right now.
And you are assuming that the Bard settlement is the end of the line. It is just one class action. What happens when the New York Times or major academic publishers like Elsevier or the massive code repository owners file their own bespoke lawsuits?
They'll settle those too.
The legal precedent is now set. Anthropic settles when caught. That means every single copyright holder on Earth now looks at Anthropic's S1 filing and sees a $965 billion piñata just waiting to be hit. You simply cannot build a sustainable, publicly traded infrastructure company when your core intellectual property, the very weights and parameters of your model, is mathematically derived from stolen assets.
You make a fair point about the potential for cascading lawsuits. I'll give you that. But look at how the broader market is reacting. Copyright litigation has essentially become a fixed cost for doing business in frontier AI.
A very expensive fixed cost.
True, but it is a line item, not a death sentence. Every major lab, OpenAI, Google, Meta, is facing near-identical suits regarding their training data. If the market truly viewed this as an existential threat,
Anthropic's valuation would have cratered when Project Panama was revealed.
They ignored it.
Instead, their valuation doubled from $380 billion in February to $965 billion in May, right in the middle of these highly publicized court proceedings. Wall Street has clearly priced in these settlements. They view copyright payouts as a toll road you have to pay to build the intelligence of the future, not a roadblock that stops the journey.
Wall Street has a long, tragic history of aggressively ignoring systemic risks right up until the exact moment the bubble bursts.
That's true.
We saw it with the telecom infrastructure build-out in 1999, and we saw it with mortgage-backed securities in 2008. The market is pricing Anthropic for absolute, unblemished execution. But pricing in perfection leaves zero margin for error.
Meaning?
If Anthropic misses a single step, if a new open-source model drops tomorrow that matches the reasoning capabilities of Claude 3.7 Sonnet for free, or if the DoD ban cascades into allied nations' militaries across NATO,
Right?
or if a macroeconomic downturn causes enterprises to slash their IT budgets just as their $180 billion in compute commitments come due, that $965 billion valuation will compress so fast it will make the dot-com crash look gentle. They have built an incredible machine, but it is running at 10,000 RPMs with no safety valve.
Well, as we draw this deep dive toward a close, I want to summarize where I firmly stand on the fundamental question of this S1 filing.
Let's hear it.
Anthropic's breathtaking $47 billion run rate, their unshakable stickiness within the core workflows of the Fortune 500, and their incredible capital efficiency, specifically spending 4 times less on training than their chief rival, represent a permanent paradigm shift in technology. They have definitively proven that artificial intelligence does not need to be a cash-incinerating consumer novelty focused on chatbots. It can be a highly disciplined, highly profitable business-to-business infrastructure layer. The fact that Claude Code is autonomously authoring 4% of global GitHub commits and that Claude Cowork is actively displacing multi-billion-dollar legacy SaaS incumbents like Thomson Reuters shows that their $965 billion IPO valuation is not a bubble. It is a direct reflection of the massive economic value they are currently capturing from the old software guard.
And my position remains resolutely cautious. I believe the $965 billion IPO valuation is built on a razor's edge.
Right.
It is deeply threatened by the crushing reality of $180 billion in inflexible compute debts, masked by the sleight of hand of gross revenue accounting that hides the true margins they are surrendering to the hyperscalers. Furthermore, their severe, rigid policy restrictions have already alienated the United States military, placing an artificial cap on their expansion. When you add the glaring ethical and legal contradictions of Project Panama and the looming $1.5 billion copyright settlement, you see a company that is rushing to the public markets not from a position of unassailable strength, but to socialize its massive risks while capitalizing its early venture investors before the compute bills come due.
Yet, despite our profound disagreements on the underlying sustainability of their financial model and their ethical framework, there is a clear point of convergence between us.
I agree.
We both agree that this upcoming October 2026 IPO is going to be the ultimate stress test, not just for Anthropic, but for the artificial intelligence industry as a whole.
Absolutely. This S1 filing marks the crucial transition of the AI space. We are moving away from the speculative, opaque realm of private venture capital, where hyperscalers can artificially inflate valuations through circular vendor financing rounds, and stepping into the unforgiving, strictly audited scrutiny of the public equity markets.
The true test of Anthropic's enterprise blueprint and whether that towering skyscraper they are building has a solid bedrock foundation or is truly just a fragile city suspended in the clouds will only be fully revealed once the S1 paperwork goes completely public and the insider lockup periods finally expire. There is an immense amount of nuance still to explore in this material as more documents leak and the roadshow begins.
If you found this episode valuable, please like, subscribe, share, follow, and turn on notifications. It helps us continue bringing you content like this and ensures you never miss future releases.